Hello everyone, Dave Landry here from DaveLandry.com. This is Trading Simplified. So what do we talk about? Well, I want to talk about the methodology in action, but more specifically, putting the theory into practice. When I was just starting out and becoming very serious about becoming a full-time trader, I learned really quickly that the map is not the territory, and I think that's the missing piece. And that's one thing that I want to start to do, or continue to do, I should say, more and more, is kind of closing that gap between the theory and the practice. And that'll make more sense in just 1 minute. Along those lines, discretion can make a huge difference in your performance. And I have an example of that I didn't even realize that one of you guys being a client, actually pointed out. So I thought that was pretty cool. And along the lines of putting the theory into practice, setups don't exist in a vacuum. And again, that'll make more sense in a minute, but you really have to look at a lot of different things, especially things bigger picture wise when looking at a setup. Now, this week, I'm just going to focus mostly on the setup itself, but you do have to take into consideration, he tried to say other things, such as the overall market and how the sector is performing. And something that's very important too is how the stocks within that sector are also performing. I want to do a bear market update. Basically, this is a continuation from what I did a couple of weeks ago in my week in charts show, and then we actually have some improvements upon that, so I'm pretty excited about that, and I'll show you that in a few minutes. Housekeeping, I do take requests. It makes my job a lot easier knowing what I'm going to cover ahead of time and knowing especially what you want. And I've been doing this lately more and more with my week in charts. I wake up on Thursday and just ask my Facebook group, hey, what do you guys want to talk about? And they give me plenty of topics. So that's been working out really good. And if you watch the more recent shows, if I say so myself, I think they've gotten better and better. So feel free to shoot me an email if there's something you want me to cover. If I can't fit into this slot, which right now is still being recorded, I can cover it live in the week of charts. And I think that makes it a little bit better when you go live with these things. That way I get a little back and forth, and I know whether or not I'm answering the question or not. If you want the slides from this presentation, all the other presentations combined, davelandry.com/StockCharts. I'll also give you enough stuff to keep you busy for a long, long time. If you want to join us for the webinar, and as I say each week, register if the link is old or the date is old, because it probably will be. Go to davelandry.com/webinar. And there's my new improved, as some might disagree with, Twitter handle at tfollymoron.com. All right, let's jump into the mystery charts and the methodology in action, and more specifically this week, putting the theory into practice. So here's our first mystery chart. Here are the parameters. As you can see, entry 290, protective stop of 250, IPT of 330. This spreadsheet is available for free. It's part of the davelandry.com/StockCharts, more information stuff. And that gives us risk of 40 cents. Obviously, the entry minus the stop, 40 cents. And then you add that 40 cents to the entry, and that gives you the IPT of 330. And this is what it looks like on the chart. You can see nice uptrend here, and we'll pick this one apart in quite a bit. Followed by a deep pullback, entries here, stop is down here. Initial profit target is right toward the old highs. What's kind of cool about the way this one shaped out is sometimes when you get these swing trade moves out, they make it just about to the old highs, but that's it. But in this particular case, that's where the IPT is, so that would be fantastic if it at least did that. That's what I call the better than the Pope in the RI trade. Now, as I was saying earlier, setups don't exist in a vacuum. You can't just look at the little piece of the stock that's a setup. You have to see what's going on longer term. Years ago, I was blessed and able to work with a trader, and I was hired by a different individual to do some research and programming. And as part of the package, my job was to help this trader find stocks for his trading service and his own personal trading. So I thought my job was simply going to be run some scans and tell him what I found in the scans, or basically just hand over the results. Maybe do a little tweaking here and there, or anything special he ran, maybe a little coding, but for the most part, I thought my job was going to be more like a data guy. I quickly found out that he expected me to know how to pick stocks. And the way I found that out was I gave him some stocks from the scans and I pointed one out. I said, what about this one? And he's like, it's not my pattern. And I'm like, well, yes, it is. And I explained mechanically what the computer spit out and how it is this pattern. based on the way that he defined it. He says, well, I don't like it. So I quickly realized that, again, I was going to have to do a little bit more than a little coding and a little bit of running scans every day. I was going to have to learn how to pick stocks. Now, just as a side note, what happened by complete accident then was, because the scans took about 45 minutes to run, instead of just sitting there twiddling my thumbs, I decided that I was going to make a copy of the database, create a tradable universe, and I had a little quick and dirty type of program that I would run that would just show me the charts, and I could only go forward. I couldn't go back. If I missed something, I missed it, so I had to pay careful attention. Anyway, long story endless, through the process, I learned how to read charts, and he was a big help too. I would give him setups that he would say yes or no, and then I would learn what to look for. But anyway, that's how I learned how to read charts. And if you want to learn how to read charts, I would suggest that you look at a lot of charts and then notice what's moving, notice what's not, notice what's working, notice what's not, and your life's going to get a lot better. And your stock picking will become much, much better. Now, this stock here was kind of all over the place, as you can see earlier this year, and really wide and loose, kind of trading like electrocardiogram. You want to steer clear of a stock that does that. Now, keep in mind that these price bars are telling you what the people did trading-wise, and it's just a reflection of their personal psychology, and that's why technical analysis, not the mumbo-jumbo technical analysis, but technical analysis in general can work, is because you're reading the psychology of the market, and you're looking to take advantage of the trader's predicament. But you can see that it kind of began to get its act together. The wide and loose base began to tighten up a little bit. It bottomed out nicely and pulled back, and it became kind of a big picture cup and handle in addition to everything else. Now, in more recent times, what I liked about the setup, which initially caught my eye before I began to pick it apart, was the fact that it was in this persistent and accelerating uptrend from major lows, multi-year lows. Now, the thing is, persistency is one of the most powerful things to look for in a chart. And that's just simply, does a stock tend to go up day after day after day? Mathematically, it's equivalent to linear regression, and I've messed around a lot with various time frames in linear regression and studying this. I know you probably want to party with me. And the bottom line is, just draw a line through as many bars as you can, and the more you can intersect, the better. So ideally, you want a persistent trend, accelerating trend. Now, in this case, this is a pretty serious pullback, but the good thing about a deep pullback like this, especially after a stock has ran 100% or more, as this one did, is it shakes out some of the players who might not have deep pockets. And these are the guys that are kind of the last ones in, first ones out. And I'm going to flesh that out in a little more detail when we get to a TKO setup in just a few minutes. But anyway, when something really takes off, I like to see a deep pullback. Now, in this case, a cheaper stock, the shorts probably aren't as prevalent, but in a higher price issue, when they pull back deeply like this, it likely attracts a lot of them in. Should the trend resume, it'll squeeze out those players. And also, the Johnny-come-latelys who were just knocked out will likely come rushing back in. And that's kind of the whole theory behind the trend knockout pattern. Again, we'll get to that in just 1 second. So anyway, nice persistent accelerated uptrend followed by a deep pullback. Now, another thing I notice is right here you have some overhead supply. And you can see that the stock sold off below that supply, but that turned out to be a fake out. And then it took out the top of the range. Now, through years of looking at charts, I have observed that if you let a stock bust down from a trading range and it takes out the top of that trading range, that will actually test out, so to speak. I'm making little air quotes because test out means, from my observations, it seems to work. Now, I wouldn't trade just off of this, but if you find a pattern that you like to trade, a setup, then by all means, putting this behind you is a great idea. Now, longer term, you can see this stock was in a long-term downtrend, but then that downtrend began to slow. And again, just think of this as a lot of people who are slowly getting rid of the stock, and a lot of things occur to help a stock bottom out like this. Could be death, unfortunately, taxes, estate settlements, and a plethora of other reasons why people might sell stocks. As Tom McClellan's mom once said, Paraphrasing, people buy and sell stocks for a variety of reasons. Some buy when they have money, some sell when they need money, and others use more sophisticated or far more sophisticated techniques. But anyway, you can see that trend did slow down, and the downtrend became a base, became an uptrend. One of my favorite patterns is what I call the Phoenix strategy, and that's when a stock goes down in bases for weeks, months, and maybe even years at very, very, very low levels, and eventually takes off. A friend of mine, Dick Fruth, he runs a bunch of money over in Texas. He calls them tombstones, and he has a book, Parabolic Trends, and I'll get the exact name for it. I'd recommend you read his book. And he was going to include my bow tie pattern, but just one thing led to another, and it just didn't work out in time for publishing. But basically what I'm doing is something similar to what he does, is look for these big long bases, and then I'm looking for one of my patterns within that big long base, and that's what I call the Phoenix strategy, in case you hear me talking about that. So here's a stock that is not a mystery chart. I had it set up as a mystery chart, but technically it did trigger on a mechanical basis. And this is basis by trading service. And I would say 99%, I believe, of all stocks I show you here as mystery charts come directly from my trading service. They are direct recommendations by me. In this case, it did trigger. So you can see the entry was actually 880, but a plausible trigger around the open would have been 881. And so far, it hasn't worked out, as you can see. Now, let's take a look at that. So you had a nice thrust higher. Now, this is a metals stock, so metal stocks can be a little choppier than stocks in general, so you do have to give them a little bit of a pass, but you still want to make sure it has as many pieces as possible. So the entry was here. It's triggered the entry and came right back in. Stop is here, and then the IPT is up here. Now, remember, at the initial profit target, we're going to exit half of our shares and move our stop up to break even. Now, we don't wait until the IPT is hit before we begin trailing that stop higher, but we don't get it to break even until and unless it actually hits that IPT. Anyway, let's back the chart out a little bit and notice that this thing went down for a long, long time. It based and then took out that base and then came back up and formed a cup and handle, or if you prefer, a saucer and handle type pattern. It was also a bow tie, a first thrust, and some of the other patterns that I like to trade. Now, again, you have a lot of overhead supply if you were to try to buy that stock at lower levels. And these little squiggles on the chart, these little bars, aren't just little magical squiggles. They actually represent the trading of people. So likely a lot of people are holding the stock at those levels. And once a stock drops below those levels, they'll be looking to get out at break even. It's just human nature. So once again, we got to fake out below, and then we got to take out above the overhead supply, and then of course a setup within all that. So that's why I liked it. So let's shift gears and talk about using discretion, and then we'll come back to another mystery chart. First of all, here's a 5-minute chart, and you can see that this was Friday after Thanksgiving, and kind of thin and choppy trading. The stock gaps open overnight, and usually I'm very cautious on these fast moves on the open, and just to be frank, I actually missed this move. And by the time I looked at the chart, which it actually took like 1 minute, I noticed that it was dropping for the day, and I didn't realize that it actually triggered a mechanical basis. But anyway, a fast move on the open, you have a gap, which was right at the, or a penny above the entry. It shot up a little bit, about 8 or 9 cents, and then it came right back in. Now, when this occurs, you can't just sit there and say, well, I'm going to wait 10 minutes, because it might make the crux of its move in those first 10 minutes. But if it quickly comes in, especially if you got a lot of other things to look at, and not to put salt in anyone's wound, pour salt in anybody's wounds, who took the trade mechanically, especially if you're newer to my trading service, I'd recommend you would take everything mechanically, and then as time passes, learn to use a little bit of discretion. But once you are a little bit more advanced and you kind of got a feel for how the methodology works, then you can let these things open, and if you get a fast trigger on the open or a fast move on the open like this, especially with a gap, especially on a shortened holiday session, then you could be a little bit more relaxed and say, well, let's just see if this thing can follow through, and then have a point where you're going to enter if it does. And in this case, it was when, again, within like the first minute of trading, it came exactly right back in. Like exactly 1 minute, it had already turned negative for the day. So again, this was a fast move on the open. in a case like that, if it keeps on going, at some point you have to make a decision whether you're going to go or no go in the trade. Since it wasn't that much above the entry, it was only 1 penny above the entry on the open. In a case like this would be a go. And then you just decide on how much wiggle room, so to speak, you're going to give it to avoid getting entered on noise alone. So the new entry where I'm looking to get back in would be above this high, around 890, let's say 891 or so. And I might bring that down a little bit if the stock sells off any further than it already has. So again, we would bring that entry up a little bit above that fake out that it did on Friday. And as you can see, and let's hope, a word you should never use in this, or a phrase you should never use in this business, but let's hope that it does go back up and re-trigger. But should it not, just this little bit of discretion would have helped to keep you from putting capital into harm's way. Now, discretion, a little bit more advanced technique, but over time, you can learn how to apply a little discretion. And keep in mind, it's not on every trade every day. It's only usually about, on average, every 3 months or so. And I'll show you a huge example here in just 1 second. So here's another mystery chart. Once again, we have that reoccurring pattern of an accelerating uptrend. This is a textbook TKO, and I'll walk you through that. Entry of 1018, stop of 7, IPT of 1336. That seems a little extreme, but that's what the setup calls for based on the volatility of the stock. So once again, we've got a nice, persistent, and accelerating uptrend, followed by a TKO move. Now, in this case, you can trade the TKO in more of a textbook fashion, and I'll flesh that out in just 1 second too. Entry above, stop below, and then the IPTs are actually a little bit further up here, around 13, I believe. In fact, we can back this out and see. So the IPT, yes, 1336 on this one. Now, notice, backing the chart out a little bit, this stock had a tremendous base, 3 or 4 months where it just based sideways before it took off. And I always thought this was my phrase, but it's actually Ralph Acapora, and I thanked him for giving me that at ChartCon. But Ralph Acapora often says, the bigger the base, the bigger the launch into space. In this particular case, you can see stock took off nicely and accelerated higher before the TKO move. And I love these TKOs that come after accelerated move because everybody is rushing in to get the stock, and all of a sudden, bam, they get knocked out. Some shorts get sucked in, and then if the trend resumes, if it triggers, then you're able to take advantage of the predicament of these traders. So if we zoom in a little bit more, once again, nice uptrend, nice persistent uptrend. Notice you can draw a line through most of the bars. Again, mathematically, that's the equivalent of linear regression. So you've got the trend, and then you've got the knockout move, which shakes out the nervous Nellies, the Johnny-come-latelys, and sucks in some shorts. If the trend resumes, then again, you get to take advantage of the predicament of these traders, and you can trade them in a textbook fashion. That's why I call it a textbook TKO. Entry above the high, stop below the low. Entry minus the stop gives you your point risk, okay? And by the way, because we're using such a big point risk, we bring our share size down accordingly. And that aforementioned spreadsheet will do all this for you. So let's shift gears. A couple of weeks ago in my weekly charts, I thought it'd be a good idea to see how we were doing in the bear market of 2022 vis-a-vis the trading service. Now, the first thing I did was I took a look at the S&P 500, down about 17%. That was a couple of weeks ago. And in fact, we're right around that same area, so that number hasn't changed a whole lot. But that is a pretty significant drop for the year. Now, what's more impressive is peak to trough, we were down nearly 27% in October. And that's a number that I think you really need to pay attention to when you're comparing your performance to the market. Because if you're down that much and you're not getting out of stocks, and those stocks came back, getting out of stocks that obviously should have been stopped out of, and they came back, then that's just bad behavior. So how are we faring? Well, results that I'm going to show you are hypothetical, and they're based on mechanically following the recommendations, though. So in other words, there's no hindsight. Yes, they're hypothetical, but there's no hindsight. And keep in mind that I do apply a lot of discretion. Now, when I put this slide together a couple of weeks ago, I said discretion can help greatly, Although I didn't have any huge examples for the year, a few missed IPTs. Now, since I said this, a few missed initial profit targets, and that's where a stock rallies up. It gets close. Let's say you're looking for 3 points. Let's say it gets to 2.75 or 2.85 points. And especially in this market, that's close enough. You can go ahead and take those partial profits, especially if you see the stock. Let's say you're up 2.9 points looking for 3, and all of a sudden it starts coming back in. Then by all means, take those initial profit targets. So in my notes, I had a few that were missed IPTs, and I could show you what I actually did in my trades. But it wasn't enough to make a huge difference. And then one of my clients pointed out that a stock really took off, and in talking about it, we managed it by using a trailing stop intraday, and that made a big difference on the stock. So I'll show you that in 1 second. Now, as a general rule, I don't publish official results due to discretion, as I just talked about. And then I don't want to make it look completely like a tip sheet, like here's a stock, go out and trade it and do exactly this. In other words, use a little discretion maybe. But I also want to show you what's going on in the market, add a little color commentary to let you know where you are. And then I also have an ancillary list of stocks, which when conditions are fantastic, can really be a fantastic list of stocks to pull from. And there's some ancillary things you could do there. Now, I've said it before, probably too many times, but I had one client that he told me he made enough to put 2 down payments on his investment properties by just taking my Landry list, putting them in a little free app, and sorting them by relative strength and buying the top 2 or 3 for the day and then exiting by the close. A little intraday strategy there. Now, I don't recommend you rush out and do that tomorrow, but when things begin to improve, sometimes it could be that simple. Just stay in stocks that are set up and strongest for the day. Now, the real money is in the longer term trading, is in the swing to intermediate term trading, which I like to show here, which the service is based on, which is my core methodology. But I will do some of these other things because, hey, I'm here all day anyway. So in the open portfolio, as of December 31st, we had 2 stocks in the portfolio, APG and ARLP. Now, ARLP has been our big winner for the year, but APG stopped out. So we were actually more profitable at the beginning of the year than we were later into the year when this one stopped out, obviously. So that was a loss, an open loss of $2,635. Now, I've done a little reading and watching videos and such on the turtles, and I learned that Dennis was okay with open profit drawdowns because it comes with the territory, but was much more concerned about open losses, especially if you weren't following the system. Now, the reason that we see each position to its fruition is because sometimes we're able to continue to ride those trends. So the mark-to-market on ARLP was based on when I did this mark-to-market was up another $9,260. So that one worked in our favor. So as you can see, at least in this particular case, instead of just bailing on everything at the first signs of adversity, let everything work itself out. Yes, it's going to suck, to put it mildly, giving up those big open profits. But longer term, you're going to do much better because occasionally you'll get one of those big winners. Now, the closed positions was a bit of a bummer, and as I said, I looked at the notes I put on discretion in the service itself, but my client did point one out, or one client pointed one out, which was interesting. Now, we did have another $1,500 in dividends, which is a rare thing. Rarely do we have any dividends based on the momentum trading we like to do. So for the year, mechanically up about 3.9% versus the market that was down 17% and much more earlier this year. Now, I did go in and study the trade that somebody mentioned, and I recommended 500 shares per 100K. In this particular account, I took 1,000 shares, and I took off 500, and then I took off another 500 here. So if you looked at this, this would be $888 per 1,000 shares. And then if you add up the rest of the trades that I did here based on this one stock, it was another $1,371. But if we're just looking at the 1,000 shares and normalizing them for a 100K account, it would be an additional $4,400 were made based on this. Now, if we add that in, it's going to make the numbers look a lot better. So instead of a negative number here, you can have $189. So this number is going to look a lot better. So that's about 8.3%. Now, as I'm doing this number is going to be slightly lower because there was a small profit in that original trade that's reflected in that negative 4214 number. But it's still going to be about 7% for the year, which is much better than a poke in the eye for a bear market. Now, I'm not blown away by those results, but anything profitable in a bear market is a good thing. So just a couple of notes real quick. I'm far from happy, don't get me wrong, but again, anything positive in a bear market is a great thing. Again, open profit drawdowns suck, but they come with the territory. And that's key, just realizing that these things can happen, realizing they suck, and just learning how to live with them. The outliers remain key. Making $20-something thousand on a stock and having that stock still open is very important for your performance. And as I said a second ago, see each position to its fruition. And discretion wasn't huge except for that one example that I just showed, but it can be. Keeping you in just one outlier or a few initial profit targets versus a full loss can make a big difference. Now, just kind of rush through a recap here. I did do a longer version of this a couple of weeks ago, and you can find that on my website or YouTube. Well, that's all my time for today. I want to thank everybody for watching. Again, follow-up information, davelandry.com/StockCharts, and I'll give you my 3 books in PDF format so you can learn about the methodology. And you can reach me at davelandry.com/contact. I'm also on YouTube. Just look for @DaveLandry on YouTube. Thanks for watching, and may the trend be with you.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.